My name is Brian Brown. That's my email address, this is the only number in there, h2oecon.com, and my website is www.h2oecon.com. And if you go around my website, you'll find I've added my various articles, publications, and TV shows. So if you're interested in the type of economics I've been pursuing. Now, for this lecture, I'd like to discuss wealth maximization by a firm that is selling into two markets. So it's got two prices. And why do I use wealth maximization versus profit maximization? Mainly because profit, we'll refer to profit with pi. Pi is an unexpected increase in wealth. Now, you can't forecast an unexpected increase in wealth. I mean, an example of this might be you're walking along a path where anything you pick up you could have private ownership of. You pick up a gold nugget, which is yours. It's completely unexpected, and so your wealth has been increased. And wealth is simply the sum of I, which is the first period 1, to the last period which you have an asset, revenues minus costs over each period, I, divided by 1 plus your discount rate raised to the T. And in each T you discount it. So time goes between I and N, and the periods go between I and N. So that's a simple definition of wealth from that particular asset. And I hope that, this is not a lecture in capital theory, but always revenues minus costs discounted over the term of the holding of the asset. Now, if you had an asset like the famous British consul, which was issued during the Crimean War, and we're talking a lot about Crimea right now, so when France and England invaded Russia, they issued, to finance the war, they issued British consuls, and these consuls were equal to £5 a year. Per year, per annum. So, oh no, that's not right. Per year, sorry. Per year, no expiration date. Basically out to infinity. This lambda represents infinity. So you can see that. So how do you discount an infinite series? Now, without going into the calculations, if you keep taking this denominator of the quotient out to a long period, it basically goes to 0 because you keep raising it to the TPR. So so a simple-handed way of doing this would be put 5 over your interest rate or discount rate that you're using. So if it's £5 over, and your discount rate is 10%, it's equal to 50. 0.1 O divided by 5 is, so that would be the present value. That's how much you'd exchange that, the right to hold that console forever. And it's a simple, quick-hand way. You can do this very quickly for all long-term assets. But that's not where we're going. We're getting back now to why I will continually talk about wealth versus profit maximization. The famous economist Armin Alston, in the UCLA PhD exams when I was a student there, asked, why can't you forecast profit, and why can they not build into an asset unexpected deterioration in wealth? Because also known as obsolescence. So I'll just make that point here before we move forward with this lecture. So why can't you forecast obsolescence and profit? You know, there's much talk that automobile manufacturers built obsolescence into their automobiles. Well, you can't really build in something that's unexpected. You can build in a depreciation schedule where the value decreases over time, and value, and this could be based on all sort of criteria as efficiency, but you can't build in something that's just going to become obsolete. A good example of obsolescence might be somebody that had spent a lot of time learning how to shoe horses, and along comes Henry Ford's T model, and he couldn't find any work, so his skill was more or less obsolete. But then, of course, we know that people at race courses and many specialty horse events, there are skills, but there wasn't. It's sort of like a general statement for the people that would have been training, a lot of smithies as they call them. There would have been a lot of them whose skills became obsolescence with the unexpected efficiency of the automobile. Anyway, but it's just unexpected as an example, and you can debate the efficacy of that example. So let's continue on about, we're really talking about pricing in two models and wealth maximization. So if we have our normal diagram, we have our demand curve, our marginal revenue curve, and we have our marginal cost curve. And our marginal cost curve, and here's units per time, and we specify the time, mostly a year, a month, a week, whatever, and up here we got the price. Very important that you label the Y and X axis. We know as the price goes down, more will be demanded, and as the price goes up, it will be an incentive for producers to bring more units online. You know, if the price is very low, they're not going to want to bring many units online because of the cost structure of their organization. So we've talked about this in prior lectures, and we'll talk about it again. We know at the point where marginal cost equals marginal revenues, profit or wealth is maximized. I said it there, I said the P word, but so we know that. So at this point, and that will, at this price, and this is the point, and this is the amount of output that will be produced, and this is the price that will be charged at that point. And this is not a open price takers market structure. This would, if you've got a negatively sloped demand curve, you must assume that you have some market power, that there's some degree of monopoly. Even if it's an open monopoly, in other words, there's no fiat controls into getting into this, if you face a demand curve, that is, you have some monopoly power. So that's our normal model that we talk about, wealth maximization. If I say profit, it's just because profit is used so interchangeably in all aspects. Profit to an accountant is revenues minus costs. Profit to an economist, to be true to the discipline, is an unexpected increase in wealth, and we talked about that. So here's the model, the normal wealth maximizing model. Marginal revenue equals marginal cost, and this is where the producer will charge this price and produce this amount with this type of demand and supply schedules. And we know that if we had a diagram where we produced total revenues and total costs, it's the point where oh look, I didn't do this very well, but at these points where these two tangents are equal, total revenues, total costs, and if you take the derivative or the line tangent to the total cost curve and the line tangent to the total revenue curve, and I haven't done a very good job here, but so it's where this line, this tangent to the total revenue curve, is exactly parallel to that line, which is parallel to the total cost curve. This is where the greatest difference between total revenue and total cost is, and that will produce the greatest amount of accounting profit or wealth, if we assume that. And of course, we assume that this is output on this line, and on this is price. So, or dollars. I should actually put just dollars there. So we have now a fairly good basis for saying if this was like one internalized market, we would know it. This would be the solution, and this would be the structure of the total revenue schedule and the total cost curve. Let's just draw that out again and again. I apologize for my rather poor driving. I have here a little bit of this. I have a glass pane that I bought for a different reason. I put it up here as a whiteboard. Seems to be working. And we'll erase that. And so now, let's assume that we've got two countries. The U.S. is producing a very esoteric type medication. So the U.S. the domestic output in the U.S., it has a marginal cost curve that looks like this. And over here, it knows what, it may have a demand curve in the U.S. that's way out here, because the U.S. is an immense market, and I know this is a quantity per time, price, and over here, maybe another country with a very small demand curve. Oops, this is sliding away. And with each of those demand curves is a marginal revenue curve.